Hello, fellow traders. It's essential to demystify bearish trends. They represent a series of lower highs, lower lows, forming a consistent downtrend. Pessimism in the market might feel overwhelming, but it's crucial to recognize these trends as opportunities to learn and adapt. Bearish trends are not limited to stocks. They can appear in indices, commodities, or even cryptocurrencies. Understanding the drivers such as economic downturns or geopolitical issues is the first step of strategizing effectively. Keep in mind, every bearish trend eventually reverses. Knowing how to spot it and navigate them is key for skilled traders. Today we'll get into understanding bearish trends and indicators by a pajama trader. Let's get into it. What is a bearish trend? A bearish trend occurs when the market consistently moves downward, often driven by pessimistic sentiment, economic downturns, or negative news. Common in stocks, indices, and commodities, and also cryptocurrencies. I want to emphasize that bearish trends are not just about price drops. They're opportunities to strategize and learn. When fear and pessimism dominate the market, experienced traders prepare to make informed moves. Think of bearish trends as a way to understand market behavior and develop a resilient mindset. They're temporary phases that reward those who are remaining strategic. Key indicators of bearish trends. Number 1, lower highs, lower lows in price action. 2, moving averages, DMA, the price average below the 50-day or 200-day moving averages. 3, volume, increased volume during sell-offs or decreasing volume on rebounds. 4, directional movement average, DMI, ADX rising with negative DMI or negative DI above the positive DI. 5, money flow index, MFI, values below 20 suggest strong bearish pressure. Let's go through these indicators and show how they work together. Notice how the price action with lower highs and lower lows is the foundation. Combine this with moving averages to confirm the trend. Volume provides insight into the conviction behind price movements. Increased sell-off volume signals bearish momentum. DMI and MFI adds layers to validation, highlighting trend strength and money flow. Popular bearish indicators, at least to me. The MFI tracks the flow of money in and out of an asset, with values below 20 reinforcing a bearish momentum. The DMI highlights trend strength and direction. The ADX confirms trend strength. The DMI serves as a filter, identifying long-term trend direction. And volume confirms the strength of price movements, especially in sell-offs. Each of these indicators serves a purpose. The DMA helps identify the broader trend is bearish. The MFI quantifies whether the institutional money is leaving the asset, a critical clue for major moves. The DMI focuses on the interplay of directional strength, and the volume ensures that these signals have met market conviction. We'll discuss how using these indicators together helps filter the noise and avoid false signals. Real-world example, SPY. Using the SPY, widely followed ETF, we'll analyze its price behavior during a downturn. When the SPY fell below its 200-day moving average, it confirmed a bearish sentiment. The DMI's negative DI crossed above the positive DI, with the rising ADX showing strength and bearish trends. MFI below 20 indicated heavy money outflows, a sign that major players were exiting positions. Volume spikes validated the bearish pressure, such as movements often foreshadow further declines. The observations. The price broke below the 200-day moving average, and the ADX rose above 25, with the negative DI crossing over the positive DI. The MFI dropped below 20, indicating outflows, and the volume spiked during major sell-off days. Beyond the charts. Economic recession, rising unemployment, decreasing corporate earnings, and geopolitical instability. Indicators reflect market sentiment, but it's important to know the underlying causes. Economic recessions and geopolitical instability often trigger prolonged bearish trends. Rising unemployment impacts consumer spending and corporate profitability. You will need to consider these fundamentals alongside technical analysis to make informed decisions. Adapting to the downside. Short selling, profit from declining prices. Options, buying puts or selling calls. Hedging, protect your portfolio with inverse ETFs. And defensive sectors, focus on utilities, healthcare, and consumer staples. Short selling allows you to benefit directly from falling prices, but it requires precise timing. Option strategies like buying puts provide controlled risk exposure to bearish trends. Hedging with inverse ETFs can safeguard your portfolio during prolonged downturns. Shifting to defensive sectors offers stability as these industries tend to perform better in bearish conditions. Common mistakes in bear markets. Panic selling, ignoring long-term trend, over-leveraging, chasing oversold signals. Emotional decisions like panic selling can lock in losses unessentially. Losing sight of the bigger picture, such as long-term trends, can lead to poor timing. Over-leveraging amplifies risk. Always manage your position and sizes carefully. Oversold signals might tempt quick entries, but without confirmation, they can lead to false starts. When do bearish trends end? A formation of higher lows and higher highs. Bullish divergence in MFI or DMI. A breakout above key resistance levels. An increase in buying volume. Identifying reversals requires patience and attention to detail. Higher lows and highs indicate a potential trend change. Bullish divergences occur when prices decline, but indicators like MFI show rising momentum. Volume spikes during upward moves confirm growing market interest. Tools for staying ahead. Use financial platforms for advanced charting. Leverage news aggregators for real-time updates. Incorporate algorithmic alerts for trend identification. Platforms like TradingView or Bloomberg provide robust tools for analyzing trends. Real-time market news aggregators keep you updated on market-moving events. Algorithmic tools such as alerts for DMI, DMA, or volume spikes enhance efficiency and reduce manual monitoring. Wrapping it up. Bearish trends are opportunities for informed traders. Use technical and fundamental analysis to validate trends. Avoid emotional decisions and focus on strategy. Bearish trends are much about mindset as they are about strategy. Focus on learning, adapting, and applying consistent methods. Feel free to share examples or ask tailored advice in the chat. Let's keep the conversation going. Remember, like this video if you gain value, and share it with others in your trading community. And subscribe for more market events and insights. Thanks again for watching.